In this session 34 of a 36-session corporate finance class, I'd like to talk about the value of control. I'm going to argue that the value of control stems from the fact that you think you can run a business better than the existing management can. And in the process, we will find that the value of control can be worth a lot, worth very little, or sometimes worth nothing at all. In these last few sessions, we've talked about the moving pieces that make up valuation. In particular, we started with cash flows and discount rates. We moved on to growth rates. We talked about terminal value. And then once we had the value of the operating assets, we talked about how to get from there to the value of equity per share. In this session, I want to build on those concepts, bring those moving pieces together into a valuation of Disney as a company. But then I'm going to use that valuation to answer a different question. What is the value of control in Disney? In other words, people talk about control premiums. Is there a control premium in the case of Disney? And if so, how much is it? So let's get the process rolling by looking at the numbers we already have for Disney. And in this table, I've collected some of the estimates I said I was going to use for Disney in the last few sessions. As I mentioned a few sessions ago, I'm going to use a 10-year high growth period for Disney because I think it has strong and sustainable competitive advantages. I'm going to stick with that decision. For the next 5 years, I'm going to assume that Disney continues to be run by the incumbent management. I'm going to call this my status quo valuation. You think, what are you talking about? For the next 5 years, I'm going to assume, for instance, that Disney's debt ratio is going to stay at the 11.58% it is right now, and that its cost of capital is going to stay at 7.81%, its existing cost of capital. I'm going to assume that it's going to be able to maintain the return on capital of 12.61% it has right now, and continue to reinvest 54% a year, which gives me a growth rate of 6.8%. So for the next 5 years, this company is going to be run as is and yield a growth rate of 6.8%. What happens after year 5? Well, I'm not quite ready to deal with year 6, so here's what I'm going to do. I'm going to go to year 11, the first year in which Disney is a stable growth company. And I laid out the assumptions I was going to make about Disney in stable growth. I was going to bring the growth rate down to 2.5%, less than the risk-free rate. I was going to assume that the cost of capital would move towards 7.29%, reflecting the cost of capital for a mature company. I also assumed that the return on capital would decline to 10%, not quite the cost of capital, but just above the cost of capital. That generates a reinvestment rate of 25% in perpetuity. The transition period, years 6 through 10, is a period that I use to adjust my numbers from high growth levels to stable growth numbers. Let me take one number to illustrate what I'm going to do. The growth rate for the first 5 years, I said I was going to use 6.8%, right? After year 10, I'm going to use 2.5%. So all I do in year 6, 7, 8, 9, and 10 is bring the growth rate down from 6.8 to 2.5% in linear increments. And I do this with every single input. So now let me show you the valuation I got with these assumptions. This picture looks daunting because there are lots of numbers in this picture, but every single number in this picture is a number we've spent time on in a previous session. Let's start below the line at the cost of capital. Let's start with the cost of equity. The risk-free rate of 2.75%. That's a risk-free rate in US dollars based on the 10-year bond rate at the time that I did this valuation in November of 2013. The beta 1.00, that's actually the bottom-up beta for Disney that we estimated using the 5 businesses that Disney's in and its existing debt-to-equity ratio. The equity risk premium 5.76%, that's a weighted average equity risk premium across the regions of the world that Disney operates in. Those numbers all feed into my cost of equity. For the cost of debt, I use the actual rating, which is single A. To get a default spread of 1%, I use the marginal tax rate to get an after-tax cost of debt of 2.4%. All those numbers feed in with my debt ratio, my existing debt ratio, to yield a cost of capital of 7.81%. Now, if you look above the line, notice that my growth rate is 6.8%. That in turn comes from my assumptions about the reinvestment rate staying at 54%. And I estimated that reinvestment rate using the 2012-2013 numbers. I looked at the net capex and change in working capital as a percentage of after-tax operating income. I also estimated a return on capital in 2012-2013 of 12.61%, and those are the numbers that are driving my expected growth rate. After year 10, I make Disney into a stable growth company. That allows me to put closure on my valuation, get a terminal value. I discount all the cash flows, including the terminal value, back to today, and what I get as a present value is about $125.5 billion. That's the value of my operating assets. Now come the loose ends. First, I add back cash, which is about $3.93 billion. I also add back Disney's investments in other companies. These are minority holdings that Disney has in a bunch of businesses, and that adds another $2.8 billion to the mix. I come up with a value for the firm. I subtract our debt, and notice the $15,961 million that I've been using all the way through returns here. And I also subtract our minority interest. You're saying minority interest in what? Disney actually owns less than 100% of Hong Kong Disney. The Chinese government owns a big stake in Hong Kong Disney. Disney consolidates Hong Kong Disney into its financials, but I have to show the portion of Hong Kong Disney that does not belong to Disney. Similarly, Disney does not own all of ESPN. A portion of ESPN is owned by Hearst Media. I've got to factor in the value of that 20%. So the minority interest reflects the portions of the companies that I've consolidated that don't belong to me, and that has a value of about $2.7 billion. Now let me pause here. On both the cross holdings that Disney owns and the minority interest, I did not have market values. I could not estimate market values. I'm stuck with using book values. That is a flaw in this valuation. And how much that flaw will cost me in terms of value, I'm not sure yet. But with those numbers, I come up with the value of equity in Disney. I subtract out the value of equity options, which is relatively small right now at Disney. It's $972 million. I get a value per share of $62.56. Remember, when you value a publicly traded company, the comparison is to the stock price at the time of the valuation. And at the time of the valuation, Disney's stock price was $67.71. So this is my valuation of Disney. You can see the numbers play in there. And I could actually take this valuation and show it to you in a slightly different way. In fact, I could frame it in terms of those three big decisions that drive corporate finance: the investment decision, the financing decision, and the dividend decision. Earlier on, I said that every single decision in corporate finance plays its way into my valuation. Let's see how each of my decisions in Disney affect my numbers. My investment decisions affect my return on invested capital, and through the return on invested capital, they affect my growth. To the extent that with my investment decisions, I build up my competitive advantages, my brand name, that lengthens my growth period. My financing decision shows up in my cost of capital. That's where I get the 7.81% cost of capital. My dividend decision shows up in the reinvestment rate, and through the reinvestment rate into the growth rate. The key in corporate finance is to remember that every single decision you make will show up somewhere in value, and the key in valuation is to remember that every single number has its root in a corporate finance decision. So the value that I get for Disney with the status quo, with the existing management running the company, is $62.56. Now let's assume that you take a look at this company and I made you CEO of the company for a day, or a year, or 5 years. You now run the company. Are there things you would change about the way this company is run? In fact, generically, if you look at what drives my valuation, here are some questions you might want to ask and answer and maybe change. The first is, what are your cash flows from existing assets, right? To the extent that these assets are not efficiently run, maybe you can introduce efficiencies and push up those cash flows. The second is, what's the value you're creating from future growth? And you can get growth from two places. One is by running your existing assets more efficiently. The other is by reinvesting better. So maybe you're not reinvesting as well as you should. Maybe you're reinvesting too much or too little. Maybe you can go for more growth, or more generally, more value from growth. Perhaps you're not using your competitive advantages as well as you should. Maybe there are some competitive barriers to entry you can put up that will lengthen your growth period. That's worth looking at as well. The cost of capital, maybe you could look at a different mix of debt and equity. And we talked about how to come up with the right mix, or a different type of debt. That'll show up as a lower cost of capital. So everything we talk about in the context of corporate finance or restructuring, you can think in terms of changing the way companies run. So you ready? Let me give you Disney to run. You just saw the valuation of Disney. Think about some of the things you might change in the way Disney is run. With all the work we've done on Disney, we could at least suggest some changes. Let's look at the growth component. Right now, Disney's reinvesting 54% with a return on capital of 12.6%. That return on capital is up from what it was a decade ago, but it's down from the 18 to 20% that Disney used to earn in the 1990s. I'm not sure Disney is going to be able to go back to those returns, but maybe a more judicious combination of acquisitions and investments with a lower reinvestment rate of 50%, but a slightly higher return on capital of 14% is feasible. If you can pull that off, your growth rate will increase to 7%. If you go below the line, remember we came up with the optimal debt ratio for Disney. Let's put that in. Let's assume that Disney is funded with 60% equity, 40% debt, and let's make all the changes to be consistent. Our beta will now be a levered beta reflecting that higher debt ratio. The cost of debt will be a synthetic rating-based debt. The cost of capital drops to 7.16%. I'm going to let that higher debt ratio flow through into my terminal value as well. That lowers my cost of capital forever. With those changes put in, the higher growth rate and the lower cost of capital, the value that I get for the operating assets jumps to $147.7 billion. If I look at the value per share that I get now, the value per share that I get is about $75. By making these changes, I've increased the value of Disney from $62.56 to $75. That's higher than the stock price of $67.71. You can already say as an investor, investing in Disney is a tricky question. Do you think Disney could potentially change, in which case $67.71 might be a good price to pay? Or do you think Disney's stuck with the status quo, in which case $67.71 might be too rich a price? Overall, though, I have two values for Disney, $62.56 and about $75. What should I call that difference? You know what? That's what I get from controlling the company. To me, that is the value of control at Disney, is the $12.35 increase in share price that I'm getting, or share value that I'm getting by changing the way Disney is run. If you take this perspective on the value of control, some very interesting things follow. First, the value of control is a function of how well or badly a firm is run. Put differently, if you have a company that's already perfectly managed and perfectly run, you know what the value of control is? Nothing. If you have a company that's badly managed and badly run, the value of control could be immense. Those rules of thumb you see floating out there, and I'm talking about rules of thumb such as control is always worth 20%, really make no sense. So if you really want to value control in a company, you have to understand intrinsic valuation, you have to understand corporate finance, and you have to revalue the company. That's about all I want to say about intrinsic valuation for the moment. Thank you very much for listening.